And I wanted to say welcome to Alex from Equivesto. Welcome, Alex.
Thanks, Craig. It's great to be here.
Great. So why don't we get into the presentation?
So, what happens after you have a successful equity crowdfunding campaign? So, we're going to cover some of the immediate, results and next steps, and we're also going to cover some ongoing requirements and ongoing recommendations. So, because equity crowdfunding involves the issuance of shares, there is, a certain amount of legal work and closing efforts that are involved compared to a sort of traditional, crowdfunding campaign. And it's a little bit different than closing a traditional investment round from a VC or an angel because you have to do some additional filings with the regulator. It is a regulated process, so we'll touch on that as part of this as well. So to start, let's talk about what actually happens immediately after the end of the campaign and what does Equivesto do on your behalf. So within the first 15 days after the end of the campaign, uh, Equivesto essentially completes our legal closing of your campaign. So we're going to prepare a list of all the new investors. We're going to prepare and make sure that all of the funds have correctly been collected and moved into the segregated account. As part of equity crowdfunding, investors actually have a 48-hour backout window. So we need to hold those funds still for 48 hours after the campaign closes to allow the final investors to have their backout window. We would also do a full reconciliation of all the funds. So make sure that everything has been transferred properly. It can still take 1 or 2 days with our payment processor to move the funds into the account. And we will invoice the company for the Equivesto success fee, which is 7% of the total raise amount. We would also make sure that all of the legal documents that have been collected, all of these subscription agreements and joinder agreements to join the new investors onto the shareholders agreements have been signed. So we would prepare all that, and then we would transfer the funds to the company minus that success fee that had been invoiced. So that's sort of the initial paperwork that we would do within the first 15 days. But that's not the only place where lots of paperwork is being done. At the same time, you, the company who's raised this money, would also need to be working closely with your lawyer to also review and prepare a series of legal documents. So you would receive that list of shareholders, and this all needs to be done within 30 days of the end of the campaign. So you would receive that updated list of shareholders and all of the legal agreements and signed documents from the company. My apologies, from all the investors. Your lawyer and your team would need to verify that those are all signed and correct, which we have also done. Once you confirm that, you would actually provide back to us the final cap table, the final list of all the investors. We provided an initial one to you, but it still would need to be confirmed by your legal team. And at that point, your lawyer and you at the company can actually make sure that the shares are legally issued in exchange for the cash. So we have all of the documents signing the subscription agreements and having the individuals join a shareholders agreement. But we also need to legally make sure that the company records that it issues shares to those individuals. So that would be done through a board of directors resolution and some potential filings that your lawyer might need to do relating to your articles of incorporation, but those are depending on the structure of your company and aren't necessarily required. So that's something you would confirm with your lawyer. So we would be working essentially together, both Equivesto and the company, to make sure all of these documents are being reviewed and completed within the 15 and 30 days after the campaign. Also, a really critical part of this is the filings with the regulators. So there are different legal regimes, which are called prospectus exemptions in Canada, under which companies can raise capital. And there are certain prospectus exemptions that allow equity crowdfunding. And we've talked about those a little bit in previous webinars. But essentially, because we're raising funds through equity crowdfunding, there are some requirements to file reports with the securities regulators. So what we need to do essentially is prepare those different reports that are required, and the company, with our assistance, needs to make sure that those are filed accurately and in a timely manner with each of the securities regulators. Because Canada is a wonderful country the way that it is, each province has its own securities regulator. So Equivesto operates in Ontario, British Columbia, Alberta, and Nova Scotia. And so we can help any Canadian company, but we can raise money from investors located in those 4 provinces. What that means, though, is after the round, we also need to file the requisite filing documents with each of the 4 provinces' securities regulators. They each have a fee that's associated with that, but it's a nominal fee, and we would help prepare the documents that are required to be filed there. So you need to file different documents also depending on the amount of funds that you've raised. So if you've raised $250,000 or less, you would have used most likely the startup crowdfunding exemption, which is one of the prospectus exemptions that I mentioned. And that was only recently added to Ontario in, I think, the past week and a half, which is quite exciting. And so that document, the offering document associated with that would need to be filed. And the crowdfunding exemption, which is the main equity crowdfunding prospectus exemption that's used in Ontario, also has its own documents. The third prospectus exemption that can be used for equity crowdfunding is called the offering memorandum, but that has much larger requirements. So essentially, each of the 3 prospectus exemptions that are used for equity crowdfunding have their own different filing requirements with the regulators. And an easy way to remember it is the more capital you raise, the more disclosure that's required to both investors and the securities regulators. So let's dive into that in a little bit more detail. So as I mentioned, for each of the different prospectus exemptions that you can raise under, there are different filing requirements with the regulators. So when you raise, you're also preparing an offering document. Regardless of the prospectus exemption you use, the offering document is the main legal document that sort of presents your securities for purchase from the general public. And so the offering document needs to be filed with the securities regulator after your round closes. Each prospectus exemption, the startup crowdfunding exemption, the crowdfunding exemption, and the offering memorandum essentially have their own offering document. And each of those offering documents would need to be filed with the securities regulator. In addition to that, you need to file what's called a report of exempt distribution with the securities regulators. I know it sounds very complicated, but Equivesto works with you very closely to make sure that all of these documents are prepared and filed in a timely manner and in a way that is not complicated. If you're raising $250,000 or less and you're using the startup crowdfunding exemption, those reports need to be filed within 30 days. If you're raising over $250,000 and you're using what's most likely the crowdfunding exemption, then you need to file those reports within 10 days. But as I mentioned, Equivesto works with you directly as part of our process to help make sure that these documents are prepared in a timely manner, and filing them is something that's very simple and not a challenge. There are also some ongoing reporting and filings that are required. So with equity crowdfunding, because you are issuing shares to members of the public and you are working under the existing securities legislation and regulations, there are different requirements for ongoing reporting. So The first and the simplest one is actually a requirement that the companies provide themselves. And that's something that's contained within your shareholders agreement. And that's that you have to hold an annual shareholders meeting, and all your shareholders, unless specifically excluded, must be invited to attend this meeting. So you have to have an annual shareholders meeting. We recommend that you do it via webinar, just like this, and you mute all the participants, and you collect the questions that are submitted inside the chat. That allows you to control the narrative while still having that engagement with your investors. At these meetings, depending on the shares that you've issued, shareholders may or may not have voting rights related to any discussion or motions that are put forward as part of that annual shareholders meeting. So Equivesto, many companies that work with Equivesto often issue non-voting shares so that they don't need to worry about any sort of voting procedure for the hundreds or thousands of new potential investors. If you raise over $250,000, you need to provide some additional ongoing disclosures. So every year, you need to provide your accountant prepared financial statements to all of the shareholders within 120 days of the end of your fiscal year. You also need to provide those statements to the securities regulator. So if you've raised less than $250,000, you don't need to provide accountant prepared statements to the regulators. But if you raise greater than $250,000, you need to provide statements to the regulator. Also, if you've raised greater than $750,000 previously, then the statements that are provided need to be audited financial statements. And that can be a bit of an expensive burden. Preparing, typical notice to reader statements can be anywhere between $1,000 and $3,000, I think, for a small business. If you're providing audited financial statements, it can be anywhere between $5,000 and $15,000 for audited statements, even for a small business. As part of that disclosure and inside those statements, you also need to include an annual disclosure of the use of the proceeds, as long as you're still deploying those proceeds raised from equity crowdfunding. So you essentially need to provide an update at least once a year saying, we raised 200,000, we've spent 100,000 of it on this, this, and this, and we're planning on spending the next 100,000 on this and this. Once all the proceeds have been spent, then you no longer need to provide that update. Also, there's an ad hoc ongoing requirement, which is that you need to notify all shareholders if there's been a specific key event within 10 days. And those events are a discontinuation of the business, a change of industry, or a change in the majority control of the company. So if any of those events happen, you just have to let all your shareholders know via email within 10 days, relatively straightforward. So what are some recommendations that Equivesto has regarding ongoing sort of requirements and how to engage with your investors now that you've raised? So we recommend basically 3 key tenets. So the first is having a digital location for your cap table that allows the shareholders to see their holdings. On the Equivesto platform, everyone can see the investments that they've made, and they can keep track of what they've invested in. But creating a digital cap table using software like CapTable.io gives your business a digital location where you can keep track of all of your shareholders. They can see updates, and you can control the amount of visibility that they have to different levels of the document in there. It provides a great place to have a legally binding digital cap table that is structured so that everyone can keep track of their investments and what is going on with the company. We also recommend sending quarterly email updates. So while the legal requirement, which we just mentioned, is, having the annual shareholders meeting and potentially issuing financial statements annually, we recommend that every quarter you send a well-written and thought out email to all of your investors, updating them on their your process, your how the progress that you've made, what you're working on, what the next steps are, because they've invested to specifically support your business. They're excited by what you're doing. They want to be involved. They want to know what you're up to. So giving them these updates on a quarterly basis can help them feel engaged and not disconnected. And finally, we also recommend that you create a specific email address to receive questions and feedback from the investors in one location. This makes it easy for them to submit emails of advice or feedback to you. Many of the investors who might support your business through the crowdfunding could have different sets of skills that they would be willing to offer to further support and encourage the business. So you want to make sure you have an avenue open where they can reach out to you in a controlled manner, where you can engage with them and understand and appreciate their feedback. So we recommend creating a specific email address at the company that investors can send their thoughts and feedback to. Essentially, there isn't a massive list of requirements after closing your equity crowdfunding round. The idea is equity crowdfunding is supposed to be a simpler and easier way for companies to raise capital compared with going public or doing a massive round with VCs and private equity companies. But there also needs to be protection for the investors because you are seeking investment from the general public. So there's the one-time filing requirements, which are essentially the two documents, the offering document and the report of exempt distribution. And there's the ongoing requirements, which are the shareholders meeting and if you raise over 250,000, the financial statements, as well as our recommendations, the digital cap table, and your quarterly email updates. That brings the end to this little bit shorter presentation. Thank you very much for listening, and let's dive into your questions.
I have a few questions. So if you're here in the chat room, we have several people here. Feel free to put your questions in the chat window or in Q&A window. Can you go back to the slide where you're talking about the different versions of equity crowdfunding, the sub 250? Yeah, this one.
Yeah.
Underneath it says requires audited financial statements. Now, is that just for the 10 million? Is that for the over 250,000? I wasn't exactly clear as to when the audited financial statements actually came into play.
Perfect. Thank you for asking that question. Essentially, audited financial statements are required depending on the amount of money that you're looking to raise at the moment, as well as money that you've raised in the past. So if you're using the offering memorandum prospectus exemption, it always requires audited financial statements, even if you only want to raise $100,000. It also has much more extensive disclosures and much longer offering document, which is actually called the offering memorandum. So often with equity crowdfunding and at Equivesto, we will use the other two exemptions, the startup crowdfunding exemption and the crowdfunding exemption, as opposed to the full offering memorandum exemption. With the crowdfunding exemption, which is up to the 1.5 million, audited financial statements are only required if you've raised over $750,000 in the past for your business. So if you haven't raised over $750,000 before, you don't need audited statements. But with the crowdfunding exemption, you always are required to provide at least notice to reader accountant prepared financial statements. So you're still required to provide financial statements from an accountant with the crowdfunding exemption, but not always audited financial statements. With the startup crowdfunding exemption, which is up to $250,000 per campaign, there's no requirement for financial statements, though it can help strengthen your campaign if you provide them. And the startup crowdfunding exemption is actually new to Ontario. So that was only recently added, actually right at the end of July 30th. So before that, so when I was presenting, for example, about equity crowdfunding in mid-July, startup crowdfunding exemption didn't exist in Ontario. And so all crowdfunding required accountant prepared financial statements, which is now no longer the case.
Yeah, and I had been confused about this originally just because I've been talking to several people, companies talking with the OSC around this stuff, and I think some people mentioned things that were coming that maybe shouldn't have, and I was confused at some point as, isn't that already here?
Yeah, it's definitely interesting. It's great that they've brought this forward and it's now available. They're also looking at adjusting the rules um, for next year in a more robust way that would also make it easier for crowdfunding in this manner and remove some of the barriers. But yeah, they brought this forward specifically because of COVID.
And you know, is there any other major difference between the startup crowdfunding exemption and the crowdfunding exemption, except how much money you can raise?
So it we're going to get a little bit in the weeds here, but
Okay.
essentially, the startup crowdfunding exemption and the crowdfunding exemption, exemptions like this are actually created by the provincial regulator. So you can use these exemptions to raise capital, but the exemption is actually applying to the investor who's participating as well. It's not simply, okay, I'm going to pick which exemption works for my company and it's going to work all across Canada. You have to match with the investor. And I'll explain that a little bit better. So if British Columbia, if you want to raise from investors in British Columbia, you have to use a prospectus exemption that the regulators in British Columbia have allowed. And if you want to raise from investors in Ontario, you have to use a prospectus exemption that the regulators in Ontario have allowed. And the crowdfunding exemption, which goes up to the 1.5 million, is not allowed in British Columbia or Alberta. But the startup crowdfunding exemption is. And so the startup crowdfunding exemption was just added to Ontario uh, on July 30th. So now you have this one rule that you can use in each of the three provinces. Prior to this, if you wanted to use the if you wanted to raise funds, for example, from both investors in British Columbia and in Ontario, you would have to essentially use both at the same time. So you would be raising up to 1.5 million from investors in Ontario using the crowdfunding exemption and up to 250,000 from investors in British Columbia and Alberta using the startup crowdfunding exemption. But you would still have to prepare the requirements for the whatever the most restrictive is. So the crowdfunding exemption requires the accountant prepared financial statements and it requires more disclosures on that side. So it's a little bit challenging because each securities regulator in each province has essentially their own rules and they can choose whether to include their province in the rules of another province or not. So the crowdfunding exemption, which goes up to the 1.5 million, you can't use that in Alberta or British Columbia, for example.
Okay.
Does that
I
make
guess
sense?
it makes sense to me, absolutely. And the other question I have is usually when you use the word startup, it has a connotation, meaning, is it have to be less than 5 years? Does it has to be a certain size? Is there anything around the
No,
business? Okay.
no, there's no there. I think the challenge is they're just trying to find labels for these. There's actual numerical designations that are assigned to them. So like 45, 506, 45, 103,
Yeah.
like those are the actual numbers assigned to um, the exemptions. 45, 108 actually is the crowdfunding exemption. Um, and then the name, they're trying to find a name that aligns with it, but they don't want it to be the same name as the exemptions in the other provinces because that can be further misleading. And so I think they're just trying to find the right names for it. But for example, as a small business, you could totally use the startup crowdfunding exemption. The requirements are generally that your business is incorporated in Canada, um, You don't even have to be in business for a full year, and you don't have to provide financial statements. You just need to, adequately prepare your pitch, and you need to have the right legal documentation so your securities that you're issuing are eligible.
All right, that sounds fairly reasonable.
Yeah, it's quite exciting actually that they introduced this startup crowdfunding exemption in Ontario because up to this point, as I was mentioning before, if you wanted to get investors from BC and investors from Ontario into the same deal, you would have to use two exemptions at the same time. This is the first sort of opportunity where you can have essentially you can use one exemption across multiple provinces, including Ontario.
How have you seen crowd companies who crowdfund use their investors, equity crowdfund anyway, use their investors as evangelists or brand ambassadors to reach out and promote their products?
Yeah, like that's something that's done in almost every single sort of equity crowdfunding round that we've really looked at. Essentially, when people are investing, you're taking people who are sort of friends, followers, potentially suppliers or customers, and you're converting them into investors. But also, now that you've converted them into investors, it's changed the way that they perceive and view your business. Instead of your business just being a great third party business that they know about and they think is fantastic, it's now an investment that they own a piece in, and it's something that they're connected with. So from their perspective, their total mindset is changed around the way that they want to sort of expand and support the business and everything that you're up to. So we find that in many of those scenarios, pretty much all of the investors, or a large number of the investors who participate in equity crowdfunding, will often sort of turn around and become big supporters online and with their own family and friends about what the business is doing. So you can it's almost sort of double dipping, because you're already taking this existing community that is associated with your business and turning them into investors, but also you're taking them and exciting them even further and taking other individuals who weren't part of your community who invested, and now turning them all sort of into evangelists for your business.
Yeah, I was talking to a startup working with Neophyto Foods, and they have a fantastic. I don't know if you've heard of them or dealt with them at
Mhm.
all. They have a fantastic vegan cheese product. And it's funny because I saw a tweet a couple of days ago, and that's what started me talking to them again. About somebody tweeted saying, that vegan cheese is a crime against God, or how bad it is. But they actually, their product is really amazing.
Mm.
And I thought, this based on take a look at how Beyond Meat is doing, and
Hmm.
there is a whole community that could get behind something like this and definitely be the champion to push it forward. So hopefully they'll be talking to you soon. But I just like to look at those opportunities, and I only bring that up because I'm not sure the businesses of the people here in the chat room or the people watching this video afterwards. But these types of things you really can take advantage of in ways you might not have thought of before, by getting your community together and then potentially leveraging that. So imagine, Neophyto Foods, just an example, going out and getting, a thousand investors of $500 each and getting, $500,000, and then turning around and going out to angels and VCs saying, "Listen, we have these evangelists out there. We just raised this in a period of time. Do you want to support us?" Do people you see that kind of thing going to the next level? Just like some people use crowdfunding as a marketing tool to see if their product is fit. Do you see people using equity crowdfunding to get to the next stage of investors?
Definitely. So equity crowdfunding is still relatively new in Canada. And so, not all the other members and sort of components of the funding ecosystem fully understand how to integrate with equity crowdfunding. But certainly in more sort of mature markets like the United Kingdom and the US and Israel, equity crowdfunding is sort of a key step in that sort of path to full funding and sort of success for businesses. So you'll see potential situations where angels will say, "Hey, you're not ready for our funding yet. Go run an equity crowdfunding round, and raise this $100,000 as sort of proof, get that initial capital to finish up your sort of prototype, and then, we would be interested in participating. In Canada, we're not exactly at that stage yet, but that's something that we're working very hard on, to sort of build those stronger relationships where, you can complete your equity crowdfunding round and then it sort of fits perfectly into going and raising at the next stage. What is exciting about equity crowdfunding as well, though, is equity crowdfunding still allows for angel investors to participate in your equity crowdfunding round. So using, for example, the crowdfunding exemption, you're raising, up to $2,500 or in certain situations, $5,000 from what we'll describe as regular investors or retail investors. At the same time, you can take up to $25,000 from accredited investors or angels within the same legal framework of equity crowdfunding. So the angels can actually come on to the platform and invest straight in your deal as part of the equity crowdfunding round. But also, we often see companies looking at doing their equity crowdfunding round first, getting that $500,000, $1 million, really, demonstrating that progress, moving to the next stage, and then looking to go out and secure VC or angel funding sort of at the step after that. And by issuing, the non-voting shares, the non-voting common shares in your equity crowdfunding round, that helps to keep the cap table a little bit simpler, because then, since it's non-voting, you can combine all of your crowdfunding investors into a single new share class, which is non-voting, and it can be represented as a single line item on the sort of front page of your cap table. So when, a new investor is looking at it, instead of, looking at it and suddenly they're seeing, 1,000 or 1,500 names on your cap table, they're seeing, okay, co-founder 1, co-founder 2, co-founder 3, non-voting equity crowdfunding shareholders, 15%, and the cap table is a little bit simpler. And then on the next tab, they can see, okay, these are all the non-voting shareholders who participated in the crowdfunding round.
So a lot of startups I talk to, they want money, but they haven't done the homework. And when I say the homework is, valuation. What's your company worth? When you go say, I need $2 million, great. But, there's a whole bigger picture that 2 million sits in. Do you find that a lot with startups that come to you, and how do you work through that valuation process?
Well, I think that's definitely something that startups struggle with and need to figure out, especially if you're at the pre-revenue stage. Determining what your company's value is very hard. I think also part of the problem is, we're looking at, Crunchbase, we're looking at the news, and we're seeing company XYZ raised $500 million for 20% of the company. And so founders in their mind are saying, okay, what percent of the company do I need to issue to raise my 500,000 or whatever? And that whole, the way you're thinking about it that way doesn't work, because it's not, you don't start with, I want to issue 20%. You start with, what is the value of my company currently, and how much money do I want to raise? And you take the amount of money you want to raise and divide by your post money valuation, and that gives you the percentage of shares you need to offer in order to get that funding. It's a very sort of simple mathematical equation, and that can sort of frame things a little bit better for founders, because oftentimes, the founder's dilemma is all about, okay, I want to keep as much control of the company for myself, but at the same time, I need to give up some control to get the money to do what I want to do to make my company wealthy. Having 100% of a pie that's worth $1 is worse than having 10% of a pie that's worth $1 million, even though it's a much smaller piece of the pie as a percentage. And investors and the founders can often get distracted by, oh, I want to make sure I keep 70% of the company for me at the end of the day. And with each round that you have, there will be dilution, because you're not selling the existing shares that you as the founder own when you raise new capital. The company, if the company has 100 shares, if you're going out to raise capital, you're issuing 20 new shares and selling those new shares from the company to your new investors. And so the percent of control that you have will ostensibly go down. It's not simply, okay, I have 80%. That means there's 20% left for this round. And that's sort of how it works. So definitely making sure you understand the valuation and you've got that sort of organized, but also understanding how share issuances work and further dilution over time works is important. And to keep going on with my very long-winded answer, it's also important to understand the impact of control in that scenario, because everyone's always focused on what percent of the company they own. But if you're issuing non-voting shares, the control of the company, it remains with the shareholders with voting rights. But for example, if you go out and raise with a VC or an angel, and you keep a higher percentage of the voting shares, but they get to pick 2 of the 3 board members, the board has a lot more control and is actually controlling the strategic decisions and long-term goals of the company. So even if you're an 80% shareholder and you have 80% of the voting rights, if 2 of the 3 board members can be set by someone else, you don't have control of your company.
Yeah, and it's a longer conversation. I guess we're going to get into that part of it next week.
Yeah.
But I thought, valuation is definitely part of things we want to talk about because, I need $250,000. I get this kind of thing all the time. Startups come to me and they say, I need $1 million. Okay, great. Have you really thought, that's
Right.
the end of the process. You got to start way over here
Right.
and work backwards. And, we've done some videos on startup valuations and stuff so people can go back and look at that. But it takes time for people to understand that and the dilution process. So, when they come to you, is it a couple of days and they're ready to go, or does it take a while for them to
No.
figure that process out?
Yeah, there's a quite a long list of documents that we require to sort of review and vet before someone can go and raise their round. If every single one of those documents, including your cap table and your business plan and your financial statements and everything, are all prepared, it will still take 2 months to prepare for your equity crowdfunding round. If your documents aren't ready, then from the moment your documents are ready, 2 months, because we need to take the time to talk about the valuation and what makes sense and the structuring. And we never make the final choice. The final choice always legally rests with the company. But we want to make sure that you're picking a valuation that makes sense for your business, makes sense for the investors, is going to help facilitate a good round and make sense. And being honest, we're not going to approve a company onto the platform if we think what they're asking for doesn't make sense. So while the valuation at the end of the day is chosen by the company, we withhold the right to choose which companies we allow onto the platform.
Is there specific companies that work best with equity crowdfunding, or is it a wide swath?
So equity crowdfunding can work with almost any company, but you're set up for success better if your company is offering a product or service that is easy for consumers to understand and sort of get behind, and you have a passionate sort of vision story about why you're in the business, as well as having a strong social media following. So those are the 3 sort of key things to determine, just looking at it from a high level, whether equity crowdfunding could potentially work for your business. You want to make sure you've got that exciting why, that sort of passionate reason for the business. You want to make sure that what you're doing in the business is going to have some impact or connection with the general public and consumers, because those are who you're going after for your investment. And if you already have an existing network of individuals who are paying attention to what you're doing and excited to participate in your business, then that's a bonus.
So thanks again, Alex, for taking the time today, and thanks for everyone who joined us live. Really appreciate it. And Alex, I'm looking forward to next week.
Thank you, everyone, for joining.